Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. So it's been a minute. We weren't here last week, but we're back. I know some people reached out asking where we were, so thank you for being a supporter and for watching us. And please like, share, subscribe, because obviously your support is appreciated. So in today's EIA show, we're going to catch up. Luckily, as we always say, we like to look forward. So for those that saw the data last week and this week, we're pretty much right on point when we're looking at some of that demand destruction, what is happening on the refined product side. On the crude export side, that's the one that's been a bit more aggressive than what we were saying. We were assuming about 3 million. So far, we're at about 3.2, 3.3, and just based on where pricing is, I think we're gonna have to take that up. And 3.3, 3.4 is probably the right number. Just when we look at what Saudi Arabia did by gunning prices, again, whether they're brilliant or ridiculous will remain to be seen. But again, those prices are very high, and it's going to make the U.S. a bit more profitable. So you should see some additional barrels leaving from the U.S., which again is going to keep us elevated. So now when we look at different things, we're going to talk about this. In the first segment, we want to talk about the small crude build. What's happening in the other products. Distillate had a small build, gasoline a draw. We want to look at what is happening around the world. In the second segment, we're going to go much deeper into U.S. Refined product demand. Gasoline, so we were expecting to see a bit of an increase in gasoline demand last, 2 weeks ago, but we really didn't get that. Now, we should see a bounce just because we've had 2 weeks of pretty, let's just say pressured demand, and that should increase a bit. But diesel is an interesting one, and we want to talk about trucking, and we'll cover that in segment 2. And then in segment 3, we're going to look at crude on the water, where things are, and how differentials are weakening, and how we continue to see discounts getting rolled into the market, especially from West Africa, and then from obviously Russia. And we're starting to see a little bit of that, or actually a lot of that, in Europe when we're seeing those differentials come under pressure. So before we get into that piece, we just wanted to look at, and this was something that CNBC had put out, where it's which of the following, if any, will you consider doing if higher prices persist? And the one that always comes back to are the first 3, which I think is the most important, because cancel a monthly subscription is, you probably, everybody on this probably has at least 2 or 3 subscriptions that you forget about until you check your credit card bill and you're like, wait, I'm still paying for that? Like what? So people will hone in and try to cancel those, but cut back on dining out, I think it is the easiest. Do you really need to go to eat out? Do you really need to go to that restaurant? Maybe instead of going to the nicer restaurant, you go to the diner just because you want to, spoil the kids or do something for your spouse. But you're gonna see, because that is easy money to save, because you don't really need that. That's not a necessity. Cut back on driving is an interesting one, and it's one that is more targeted towards the weekends and and during the week when you do trips. Can you avoid having to go to Target or the food store more than once? Make sure that you have your list, do things and then on the weekends, instead of driving somewhere, can you walk to the park? Can you do something? Because those are, again, little things that will adjust. But the bigger one, and this comes to what we've been talking about in the U.S., and we gave a talk on last Thursday to the SPE Society, and it was really looking at U.S. demand, and the U.S. doesn't have demand destruction the same way. Like, we don't go from 8.5 million barrels a day of gasoline demand to 7.5. It's when we're supposed to get that big summer bump. You're supposed to go from 8.5 to 9.5. But instead of reaching that normal 9.5, if you will, we come short. It's 8.7, 9. And it comes on canceling the trips and canceling the vacations. And we're starting to see that accelerate, because when you look at which of the following, if any, have you done in the past 6 months, it's cut back on dining is leading the way, cut back on driving, cancel a monthly subscription, switch from brand name products to generic, again, going down, but cancel a trip is still low. And that's the one that you want to look at, because that's the one that, as prices remain here, that'll creep higher. And so far, people are like, you know what, it's okay, it's manageable. We budgeted for this. But when you go away on vacation, you eat out a lot, you do things that you normally wouldn't do. So again, this is kind of that bubble of demand that we want to continue to track. Now, when we start talking about the global backdrop, total oil and product stocks have kind of flatlined, and it's really because crude builds have accelerated a bit. We had a build today in the U.S. of about 2.4 million. We had a big build in Europe as well. So again, that's going to continue to shift higher a bit. But product stockpiles remain low, and it's again if you break it down, which we will in segments 2 and 3. Distillate. When you look at distillate, you're seeing especially middle distillate, a lot of shortages. But the problem is when you make diesel and distillate, you inherently make gasoline, which is where you continue to come into these conundrums of, well, how do I increase my distillate without oversaturating the gasoline market? Which, when you look at Europe is at a record amount of gasoline in storage. You're starting to see more of that come through. Now that Ramadan is here, you have a lot of that fronted demand starting to pare back, and we're going to start to see those builds coming into both Singapore and Fujairah. But again, when you look at total crude stocks, the deficit widened from crude stocks and products from 118 to 126. When you look at deficit on crude, deficit widened from negative 43.8 to negative 51.6. And then when you look at product stocks, it went from negative 74.4 to 74.6. So again, small. But the stockpiles on the crude side is reversing, and that'll bring some of this up. But again, we're continuing to see these key pieces. Now, when you look at U.S. imports of gasoline from Europe, contracted to the least in 7 weeks, and when you start looking at what's been coming through, total European gasoline arrivals in the U.S. dropped 61% week on week to 123,000 barrels a day. Now, that's something that should start to adjust, because when we look at Pad 1 still does have some spare capacity for storage. So we will see some of that balancing act, especially as we are coming close to the driving season. Now, when we start looking at land storage, so when you're looking at land specifically, the deficit widened from 84.2 to 85.1. West of Suez, the deficit narrowed from 74.4 to 71.9. That's going to continue, just given, because this is not last week, but the week before. So we're looking 2 weeks back and coming forward. So we had a crude build in the U.S., in Europe, that'll pull us higher. And then east of Suez, the deficit widened from 18.9 to 20.9. That's something that, again, we continue to see that coming out, growing, getting a bit worse, especially when you start looking at China and what's happening there, which, again, we're going to talk about in segments, really segment 3 for the most part. So, but one of the key things that I think is interesting is crude prices are the highest they've been since obviously 2014. But when you look at Nigeria, they're not benefiting the same way, because the country, even though it's Africa's largest crude producer, they don't have a lot of refining capacity, so they still have to go out and buy product. And they're still trying to maintain their subsidies. So a lot of what they're gaining or benefiting from these elevated prices are kind of being blunted by the fact that they have to go out and buy product and they have to subsidize. So again, that's why sometimes it looks really good, but then when you start breaking it down, it's really who is benefiting when we're looking at some of these prices. On the floating storage side, surplus widened from 28.6 to 28.9. When you look at west of Suez, we're continuing to go up. We flipped from to a surplus, so we went from -1 to positive 1.5. And that's on Europe. Europe saw a big spike on the North Sea and European front in terms of North Sea and just Europe in general. So the floating storage is elevated. We actually see that staying elevated. And then east of Suez, as surplus narrowed from 36 to 27.1. But remember, as we've talked about, the transit times. So as transit continues, we expect not so much the east of Suez to come down or go up much, but really just kind of stay sideways at this point in time. We have seen the Middle East come down to a low, which again is what we were talking about as a key focal point on How strong is the market? Where's the Middle East? So we've seen some nice drawdowns from Middle Eastern storage, which also could have prompted that increase in OSPs, which we'll talk about in segment 3. But again, there's a lot of things moving and a lot of things to consider as we go forward. U.S. gasoline implied demand, you can see here that we had that continued low. We're now below where we were in 2021. So if you take out 2020 on a seasonally adjusted basis, this is the lowest we've been in the last 6 years. And I think it's an interesting piece because this is what we've been talking about, where we're supposed to get this seasonal increase. We're kind of in this no man's land. We will start to get some of that build up just because weather's gotten better. We are in spring now. So we will start to see that come back. But our whole thing is that, we really get to about 9 million barrels a day. We don't really get to that, what is normal, if you will, of that 9.2 to 9.5 on average. Instead, we're going to be a bit below that just because of pricing and the pressures that we see in the market. Now looking at crude builds, here we had a build of 2.42 million. We're still 86.2 million off the 5-year average. Pad 2 had a big build of 3 million, bringing that shortfall to 29.9, so almost 30 million below the 5-year. Cushing back up 1.65. That's still 22.3 million below the 5-year. So Pad 2 is the one where we see that increasing. That's going to continue. Pad 3 had a build of 2.16. That's still 26.5 million below the 5-year average. But the problem with Pad 3 is we're still very low on imports. And that's going to be the one to watch to see where are exports going, because they're going to stay elevated, and how quickly do we have those imports come through. Obviously, the Middle East pricing has gotten a bit difficult, but there is opportunity in West Africa and parts of LATAM. And then Pad 5 had a drop of 1.87 million, fairly in line with the 5-year average. Pad 1 had a drop of 850,000, again, very close to that 5-year average. So those are going to be the ones to watch because, again, Pad 5, as we've been saying, is lumpy. And we said earlier, as we saw problems in China arising, we do expect them to start to increase exports and to, or I should say, lift the ban on exports, just because they are coming into being a bit long on the gasoline diesel side. And especially on the diesel side, there's more than enough buyers, and some of that will appear in Pad 5. As we come out of maintenance season in both the Gulf of Mexico and as the weather increases, we're starting to see the increase in production in the U.S. We're up another 100,000 barrels to about 11.8. As we were saying the last few weeks, we're closer to about 11.9 million on our model right now. And again, it's not that we're going to have this surge. We're not. There's a lot of issues. We talked about it last Thursday at the event. There's casing availability, there's steel, a lot of issues when you look at how quickly can we get things accomplished. So that's, again, going to kind of cap how fast we see that ramp to what we've been talking about that 12.2 million barrels a day exit rate. That's not going to come all at once, given a lot of these shortfalls. So now when we look at runs continue to be strong. We're up another 34,000 barrels a day, or 0.4%. Or 40 basis point percent utilization rate. We're at 92.5. That's 5.2% over the 5-year average. Again, starting to see that move higher. Pad 3, starting to come back again. We still have some of that URE noise in there, so that's going to start coming to the other side. And then when you look at that Pad 2, that's one that we think is going to be a bit slower when you start looking at where we have some of the builds on the product side. Everything else is essentially fairly normal, but Pad 2 and Pad 3 are the ones that are really driving this overcapacity, if you will, against the 5-year, with some URE noise left in there. But again, on Pad 2, that's not the case. That's, things are a bit stronger. And when you start looking against, here's that URE that we've been talking about with that big drop, you can still see that on the 29-year average, we normally increase utilization rates at this point in time, but you can see just how aggressive they are. And we're much closer to 2018 utilization rates right now than we are anything else, as we're at that top band of underlying activity. And again, the diesel crack carries margin. But the problem is, as diesel cracks remain strong, gasoline cracks remain weak, and it's just how long can that diesel crack carry us and distillate crack carry us before gasoline becomes a much bigger overhang in the near term. And that's when you start looking at imports. So how do you increase distillate cut. Now, given we've said that before, for every barrel that is created of diesel, you inherently create 2 barrels of gasoline. You can adjust that a little bit lower. You can get it to about 1.7, and it's really just based on the type of crude you're running or the slates and how the catalyst or how the cracker is set up. But again, there's only so much flexibility. So that's why imports, again, importing something that has a higher distillate cut, something that's going to yield something a bit different, which is one of the reasons why we do believe that PADD 3 imports will start to increase. Obviously, it's a bit expensive, but there is some opportunity that is arising just given where prices are. Then when you look at PADD 2, imports remain strong. We do expect more Canadian crude to come down. There was a Wall Street Journal article about the Biden administration looking at other ways to increase the imports of Canadian crude without building a pipeline. So again, at first I thought it was an Onion article, but it was real because it's like, wasn't the Keystone meant to do that? But anyway, we've talked about that. We've beaten that one to death. So this is the market we live in right now. So when you can see, look at PADD 5. PADD 5 had a small drop, again, the lumpiness there, and we do expect to see some of those increases in PADD 3 and PADD 2 to remain strong. So PADD 3, as we've been saying, we expect it to come above or I should say to the high of 2022. We still don't believe we'll be anywhere near the 5-year average, but essentially kind of split the middle between the low end and the 5 years. So we do have some upside, especially when you look at what is slated to come. It is lumpy. We could get a drop, but again, the trend is going to be essentially halfway between the 5-year and where the lower end of the band really sits. PADD 2, seasonally adjusted high. It's going to continue to be that way. As we've been saying, the lows will be right at the 5-year. The highs will be above the top of the band. And it's all going to be from those additional Canadian barrels getting pulled down into the market and ending up in PADD 2. And just based on, as we were talking about, with the amount of storage available, there's more than enough PADD 2 storage to accept it. And we're going to continue to see that heavier cut coming down. Here's where we look at the implied demand. Gasoline only had an increase of 63,000 barrels a day. We were expecting something a bit stronger, just given how we've continued to be a bit sluggish. When you look at distillate was down another 157,000 barrels from 3.8 to 3.65. The bigger issue here is, when you look at the East Coast, we're pretty much out of heating season. Again, we have pockets, like for those that live in the Northeast like myself, I'm sure your heat probably clicks on 2 or 3 times in the night. During the day, it's probably not coming on all that much. So again, you're starting to see that slow down, and we are getting a bit of a heat up. I should say warm up. We'll talk about that in segment 2, but that'll also put a bit of a dent in it. And we are seeing a big slowdown in trucking. A lot of tenders being rejected, a lot of spot offers being rejected. Companies are sitting on a bit more inventory than they're used to. And by used to, I mean over the last 18 months. So when you look at that, they've essentially said, no, too expensive, I'll wait a month. And then as you have the retail spending coming down and you have some of those inventories remaining a bit elevated, that's keeping that trucking a bit capped. And we'll talk more about that in the Econ show. Propylene, it fell 130,000 barrels, kind of right in line with the 5-year average. We expect that to remain the case so far. This just, again, puts into context where that gasoline demand is. When you look at that weakness, and it's tough to compare it to the 5-year just because 2020 was so ugly. So again, when you kind of back that out, you get an idea of where some of those struggles are on the gasoline front. Now, when you look at crude oil inventory, excluding the SPR, we're just going sideways. As we've been saying, that's what we expect. When you factor in the SPR, we had a drop of storage by 1.32 million barrels. So on the commercial side, you had an increase. On the SPR side, you had a decline. That's going to continue. We already know that there's an SPR release of about 180 million barrels. It's just there is a certain amount of capacity constraints because you don't just pull it out all at once because it has to come from a salt dome. So again, those are going to be things that'll take time and that will bleed into the market over the next few weeks. So now when we look at days of crude supply, so we did have a small build, but remember, we have refiners operating at a bit higher levels. So we're tracking almost perfectly right now, 2018. And just based on where things are, we expect refiners to stay right around here. They could get to 92.7, but we don't see a huge surge yet. And by huge surge, I mean getting to 96, 97% utilization rate, which should be more of a May into more June event. But it'll also depend on how much gasoline is there, because we will see distillate storage. Not these massive builds, but we will see these 500,000 million barrel increases on demand into supply and storage. But where is gasoline? How quickly are we getting through gasoline? Because that's going to be kind of that pivot on how quickly the utilization rates can ramp up. So then when we start looking at commercial oil storage, remember this is crude, gasoline, distillate, jet fuel, resid. Again, flat. We don't expect much change, just trying to kind of balance this market as we go through. And the mix of, how expensive is crude? Where is demand for product? And trying to balance this to kind of keep things a bit level and steady. And that's when you start looking at gasoline. So we had a small drop here. We do expect this to essentially follow those 2018, 2017. You can see that seasonally speaking, we're normally kind of bumping along these levels. Obviously, 2020 was that massive year. We expect this just to kind of go sideways, similar to what we saw in 2021, 2017, 2016, kind of just staying at the top of this band, especially if you peel out 2020. We're in a very normal, kind of comfortable gasoline market. Obviously, the price at the pump doesn't reflect that because they still are buying crude. A refiner's trying to collect a toll. It's trying to collect the crack spread. So even though there's there's excess, their demand is weakening, it's like you're still buying crude and you're still making products. So you have to try to marry that. So again, that's why we're going to continue to see gasoline prices remain elevated, though they're weakening. But diesel, on the other hand, has remained fairly firm. So now when we look at distillate, small increase. Again, when you look at seasonality, this is kind of where we normally flatline, and then you start to see those increases. The increases is just going to be based on how many heating degree days are there, or versus normal, and where does the diesel trucking things shake out. So then jet fuel, again, bouncing around. We had some shortages, so we did see a big increase in pricing. And this is just going to be managed because, again, it's a mixture of kerosene versus the distillate cut, and where does that get pulled? Now, when you look at the WTI crude futures, when you look at the curve, one of the things that we've been talking about is the front month flattening a bit, and not so much this huge collapse in the front month, but the strengthening of the belly, and that you were going to see the curve flatten a bit. Obviously, we thought that, as we've been saying, you want to kind of short above 110, buy below 100 and kind of play the volatility game. But it's the belly of the curve that we think continues to creep higher. So if you were going to spread it off, again, it was short front month, trying to buy, whether that be December 22, December 23, those were going to kind of be the places where you should start to see that balancing. You're above 90 through essentially the middle of 23. You're above 80 essentially through until January of 2024. But when you look at just the strength, you're seeing that pull up in 26, 27. Now, this is only important because when you're starting to look at, do I do this project? What is offshore going to yield? That's when you look at this and say, well, I will get paid. And I think you will start to see that payout, especially when you start looking at how the strength in pricing on the liquids cut and where natural gas is in general. COVID continues to be around. The worldwide side, it's fallen, but spiking a bit. There's a new Omicron variant, apparently. It's now in India. India is still on the low end, so we'll see how much that starts to creep. South Korea, Japan, Vietnam, you can see kind of Japan flatlining, but the others are remaining a bit elevated. The question will be, what does Ramadan do for COVID? Because typically, as we've seen time and time again, you have a holiday and you have a spread. You have a holiday, you have a spread. So Ramadan being obviously a Muslim holy month, and there's different events that happen throughout. Will that become an event? And then obviously China continues to see, stay elevated with records being set in different locations. So keeping that at the forefront when we look at demand. Pad 3, again, fairly normal. We're right where we were in 2019, 2018. We do expect this to stay a bit flat just because we will have more imports, but we will have elevated exports, and that will support also more Permian production. Again, just because the pricing is there doesn't mean that the materials and labor is there. So it's going to be a balancing act, but that's why we do see this staying, let's just say towards the high end of 2022, which will, again, just kind of stay sideways. So it'll look pretty good, but again, we're not going to go up or down all that much versus historics. Now, when you look at Cushing continues to move up. As we were saying, it was going to be lumpy, but the trend was going to be higher. We expect that to be the case as we go through the next few weeks, and it's just going to be more of that getting stored and moving us back up into the top end of the range, because as you're pulling from the SPR, you can take from the SPR, leaving Cushing. So again, you're going to see some of those shifts back and forth. Floating storage to zero. Again, it's just going to kind of be this waffling back and forth. This will come back up, but again, stay below, well below seasonal norms, just because it's just going to be that timing. Europe is the one that's seeing the bigger increases. West Africa is still remaining at seasonally adjusted all-time highs. And again, that's going to keep us on the west of Suez side a bit elevated. So that's what we have for you in segment 1. And segment 2, again, we're going to go deeper into the U.S. And then segment 3, go more global and look broadly speaking at crude and products.